In 2018, Amazon made $11 billion in profit. Their federal tax bill was $0. Not a rounding error, the actual number was $0. The company received a refund of $129 million on top of that. That was not a one-time glitch. It was the result of a systematic strategy that took decades to build. We ran 15 years of Amazon's SEC filings. We calculated what they paid versus what the standard rate required. Then we ask, where did that money go? Amazon is not just a company. It is an ecosystem. In 2023, Amazon generated over $500 billion in revenue. Its cloud division alone accounts for roughly $90 billion. Its logistics network delivers more packages than FedEx. Jeff Bezos, the founder, has a net worth above $200 billion. The company employs over 1.5 million people in the United States alone. For most of its history, Amazon ran at a loss. It reinvested everything into growth. That strategy defined the company. It also made Amazon nearly impossible to tax. When you spend every dollar on new warehouses, servers, and fulfillment centers, there is little profit left to tax. That was the plan. But over the past decade, profits have arrived in scale, and the tax bill has not kept pace. So we asked a direct question. Over 15 years, what if Amazon had paid the standard federal corporate rate on every dollar of profit? What would that have cost them? And what would the country have received in return? We pulled the data from Amazon's annual 10K filings. We calculated the theoretical tax at the statutory rate. We compared it to the taxes Amazon actually reported paying. Then we turned the gap into concrete numbers. Here is what we found. The US corporate tax rate was 35% until 2018. The Tax Cuts and Jobs Act dropped it to 21%. Amazon's actual effective federal tax rate has been well below both thresholds for most of its profitable history. In 2015, Amazon posted its first significant annual profit. Pre-tax income, $1.8 billion. Federal taxes paid, about $260 million. Effective rate, roughly 14%, 2016. Pre-tax income, $4.1 billion. Taxes paid, about $400 million. Effective rate, about 10%, 2017. Pre-tax income, $3 billion. Taxes paid, $77 million. Effective rate, under 3%. Then came 2018. Pre-tax income, $11 billion. Federal income taxes, $0. The company received a refund of $129 million. This was the same year the corporate rate dropped from 35% to 21%. You would expect a lower bill. Instead, the bill reached $0. 2019, $13.3 billion in profit. Federal taxes, $162 million. Effective rate, about 1%. 2020, $24 billion in profit. Taxes paid, $1.8 billion. Effective rate, about 7%. 2021, $35 billion in profit. Taxes paid, $2.1 billion. Effective rate, about 6%. 2022 was complex. Amazon reported a net loss. Its investment in Rivian collapsed in value. The tax situation that year cannot be compared directly. 2023. Profits recovered sharply. Pre-tax income, $35 billion. Taxes paid roughly $5 billion. Effective rate about 14%. That was the highest in nearly a decade. The pattern is clear. Year after year, Amazon generated enormous profits. Year after year, it paid a fraction of the statutory rate. Here is the calculation. We applied the statutory rate to Amazon's pre-tax income for each year from 2015 through 2023. For years before 2018, we used 35%. For 2022, we used 0 due to the reported loss. For all remaining years, we used 21%. Then we subtracted Amazon's actual federal income tax payments. The result was the annual tax gap, the difference between what the statutory rate required and what Amazon actually paid. In 2015, the gap was approximately $360 million. In 2016, the gap was approximately $1 billion. In 2017, the gap was approximately $970 million. In 2018, the gap was approximately $2.4 billion. In 2019, the gap was approximately $2.6 billion. In 2020, the gap was approximately $3.2 billion. In 2021, the gap was approximately $5.2 billion. Add those together across the 9-year window, accounting for the complex years. The cumulative gap, approximately $27 billion. $27 billion. Not paid. Legally. Let us make $27 billion concrete. That amount is enough to fund the entire NASA budget for approximately 3 years. It equals about 18 months of federal funding for the National Institutes of Health. It would cover roughly 2 full years of the Environmental Protection Agency's annual budget. It could fund universal pre-K for American 4-year-olds for an entire year. Now break it down to the individual level. $27 billion spread across 130 million American households. That works out to roughly $200 per household per year. Not life-changing individually, but compounded across 9 years, it adds up to real-world gaps. Infrastructure deferred. Research cut. Teachers who were not hired. The money did not disappear. It stayed inside Amazon and was reinvested into the business. But the public did not share in that reinvestment. That is the trade-off embedded in the tax code. Before going further, one thing must be said clearly. Amazon has done nothing illegal. Every tool in its tax strategy is authorized by the US tax code. This is not a story about fraud or loopholes. It is a story about a code designed with specific incentives. The first tool is stock-based compensation. Amazon pays employees partly in stock. Under IRS rules, when that stock vests, the company can deduct its market value as a business expense. In years when Amazon stock was rising sharply, that deduction was enormous, sometimes several billion in a single year. It reduced taxable income directly. The second tool is accelerated depreciation. Amazon invests aggressively in capital assets. Warehouses, robotics, data centers, delivery vehicles, and aircraft. Tax law allows companies to deduct the cost of capital investments faster than those assets physically wear out. This front-loads deductions into the year of purchase. Amazon's annual capital expenditures exceed $50 billion in recent years. At that scale, accelerated depreciation is a massive tax lever. The third tool is research and development credits. Amazon is one of the largest R&D spenders in the United States. Federal law offers direct tax credits for qualifying research expenses. These credits reduce the tax bill dollar for dollar. The fourth tool is net operating loss carryforwards. Amazon spent its early years losing money. Tax law allows companies to apply past losses against future profitable years. Amazon stored those losses and used them long after the company became highly profitable. The fifth tool is international structuring. Amazon routes portions of its intellectual property and revenues through subsidiaries in lower tax jurisdictions. The IRS and the EU have both challenged elements of this structure. The legal battles continue. Taken together, these tools are individually unremarkable. Thousands of companies use them. Amazon's advantage is scale. At $50 billion in annual capital expenditures, every depreciation rule creates a larger deduction than it would for any smaller competitor. The federal tax gap is not the whole picture. Over the past decade, Amazon received over $8 billion in state and local incentives, grants for warehouses, property tax abatements for data centers, sales tax exemptions for fulfillment operations. The most visible example was HQ2. When Amazon announced a search for a second headquarters, over 200 cities submitted bids. The winning location was Northern Virginia. The incentive package was nearly $700 million. Those incentives represent a separate transfer of public resources to a private company. Cities offered them willingly. The calculation was that future jobs and local tax revenue would outweigh the cost. Whether that proved true depends on the city. For some, the economic spillover arrived as promised. For others, the math is still being debated. What is not debated? Amazon received over $8 billion in public subsidies on top of the federal tax gap. Add both together, and the total public transfer exceeds $30 billion over 15 years. Here is the counter-argument that matters for anyone holding Amazon stock. Amazon's tax efficiency has been a genuine driver of shareholder value. Every dollar preserved from taxes was a dollar reinvested into the business. AWS, which now generates the majority of Amazon's operating profit, was built during years of aggressive capital investment. The tax code rewarded that behavior. In a structural sense, the system worked exactly as designed. For investors assessing Amazon today, the key question is whether this advantage is durable. The OECD Global Minimum Tax Agreement is now signed by over 130 countries. The framework imposes a 15% minimum effective tax rate on large multinationals. If fully implemented, Amazon's effective rate will rise. The question is how fast. That is a headwind to earnings. Amazon's management has acknowledged the global minimum tax as a risk factor in its SEC filings. Investors should take that disclosure seriously. The tax advantage that helped build AWS may gradually become a tax liability. The direction is clear, even if the timeline is uncertain. $27 billion over 9 years. That is the federal gap between the statutory rate and what Amazon actually paid. It is tempting to frame this as a moral story. The more useful frame is structural. Tax codes reward what governments want to encourage. The US Code has long rewarded capital investment, risk-taking, job creation, and R&D spending. Amazon optimized aggressively for all of those things. The result is predictable. A company with unlimited resources and a sophisticated tax team will extract every available advantage from a complex code. The story changes if the global minimum tax fully succeeds. It changes if domestic reform gains momentum. Both are live possibilities in 2026. For investors, tax efficiency is a real competitive advantage. It is also not permanent. For everyone else, the gap between what large corporations pay and what the code says they should pay is not an accident. It is a system designed to incentivize certain behaviors. Companies large enough to optimize that system will do so. Every dollar has a story. Amazon's tax bill tells one of the most important stories in modern finance. The question is not whether what Amazon did was legal. It clearly was. The question is, who benefits when the tax code is this complex? If you want to understand how money really moves through the global economy, subscribe. We run these numbers every week. Leave a comment with the next company you want us to analyze.